With earnings coming up and the conversations that we've been having over the past few weeks about looking at straddles and strangles for earnings, Terrie wants to delve deeper into the perfect structure, or the structure we prefer, or some guidance to a structure. So which is best, straddles or strangles? Long or short, meaning buying a straddle or strangle, or selling a straddle or strangle? How far in advance of earnings should we place the trade? 2 days, 5 days, 20 days, 40 days? How far out in expiration? Same week, following week? And how do we trade straddles or strangles? All right, so let's get to it. First, long or short, meaning buy or sell. We prefer here at Power Options to buy the straddles and buy the strangles, doing long straddles and long strangles. Why? As we head towards earnings, we know there's an increase in implied volatility on the options. They're going to be fairly expensive. But what are we planning on? We're planning on a movement. We're expecting a movement one direction or the other to get a return. Selling might be lucrative, but it does take on too much risk. You can find yourself in a lot of trouble very quickly by selling a straddle, specifically the at-the-money straddle, which will give you a high return, but again, it's going to have a high risk, or selling the strangles. Even though we know we're going to see an IV crush, we prefer to buy based on our testing. Again, we're expecting a move. We're expecting the unexpected. Buying complements that, not shorting. Shorting complements neutrality, no real movement, hope for a decay of implied volatility if the stock doesn't move more than 3, 4, or 5%. So if you're expecting a move, significant move, or a move of even greater than 5, 6%, you're going to want to look to buy, doing the long straddle and long strangle. Now, straddles or strangles, which one is correct? Well, it depends on what the stock does, but it also depends on your risk tolerance and expected move. A long straddle is a V-shape profit and loss chart. We're going to buy a call and a put at the money at the time we open the trade. So we'll have a V profit and loss chart with the maximum risk here if the stock doesn't move of whatever the total debit is. This gives us a higher cost because we're buying two at-the-money options that will have the highest time value. But in general, compared to the strangle, which is an out-of-the-money call and an out-of-the-money put that gives us a flat U-shaped profit and loss chart, we're going to have a higher lower break-even and a lower upper break-even, meaning we need less of a move from the stock to hit a profit point. Whereas here, yes, we'd have a lower cost, but the stock needs to move to that strike price, then beyond it in order to get a profit, to the strike price and beyond it in order to get a profit in that case. So you're going to have a much higher upper break-even and, in this case, a much lower break-even. It is a lower cost, so it's a lower debit, lower risk if the stock doesn't move and you receive a 70, 80, 90% loss because you only saw a 0.5% movement on the stock where you're expecting 5, 6, or 7. But it does have a lower cost into the position. So that's what I mentioned by sort of the risk tolerance and how much you want to invest into the trade itself. Now, ignoring Terrie's other questions for the moment, let's see that in action, shall we? On January 10th, Target was trading at around 125. A few days before that, it was around 124. 10 days before that, it was around 130. But on January 10th, Target is at 125. Earnings are coming out in 5 days. The at-the-money straddle, buying the same strike call and put for the same expiration, what I likely would have done on January 10th, is to buy today's expiration. Earnings were coming out on the 15th. So buying today's expiration, the 17th, the closest to the earnings date, if available. I'll talk about that more in a moment. But at the time, the at-the-money call would have cost $330. The 125 put at the money, same as the stock price, would have been $350. Total into the position is $680 for the call and the put. So my upper break even, well, if it goes to 130.80, the put will go essentially to 0. The call is going to go to 680 of intrinsic value. Sell to close the call, you'll be at break even. On the downside, it's at 118.20. I need the stock to fall 680 from the time when I entered the trade to hit that profit level. The strangle, the out of the money position. So here's your V profit and loss chart with a stock rate at 125. Your strangle, sort of that U-shaped profit and loss chart, buying the out of the money 130 call for $1.25 on January 10th. Buying the 120 put for $1.70. So your total into the strangle is $2.95, less than half of the cost of the straddle. But remember, in order to start seeing value intrinsically in the call and the put with this short a time to expiration, I need the stock to go to 130 and then $2.95 beyond. So my upper break even is 132.95, about $1.10 higher than the straddle. The lower break even is 117.05, again, about $1.20 or so down, $1.10 or so down from the straddle. So I need more movement with the strangle, even though it's a lower cost in this case. So what happens? January 15th, Target has a poor earnings surprise, falls down to 117. It was around 126, 124, same in that range, but a 6.6% drop down to 117. What happened to the straddle position? Well, the 125 call goes to zero. We've got 2 days remaining to expiration. It's got no value. So it goes down to 1 cent or 2 cents. The bid at the time was 1, the ask was 4, so we could assume we get about 2 cents at midpoint, hopefully. 125 put at 8.25. Pretty much intrinsic value, right? We're at 117, got $8 of intrinsic value plus 25 cents. I bought to open both, so to close it, I'd sell to close both. We get 827 back. Remember, my cost was 680. For 330 for the call, 350 for the put. So we have a profit of $1.47 or 22% on the straddle from a 6.6% move. The strangle. What happens? Well, drop to 117. The 120 put goes up to 305. 130 call was zero. When I looked at the chain on the 15th, at the close of the 15th, it was a zero bid for the 130 call and a 1 cent ask. I can't guarantee that you'd get 1 cent for that, so I'm just going to leave that as is. So in this case, the liquidation value would have been 305. Paid $2.95 in, so we make a 10-cent profit, or 3.3% on the position. Now, could I realize a higher profit in this case if the stock had moved down 10, 12, or 15%? The strangle might have started outperforming the straddle, possibly. Not monetarily profit, but percentage-wise, because I'd still be getting more profit here, because what happens? When the stock fell with 2 days left to expiration, both the 125 put and the 120 put are getting close to a delta of 1. So any further decline to that, we're getting almost dollar for dollar gain in those two puts. Or if it went up, be getting dollar for dollar on the calls as well. So eventually, we might get to a $4 profit, $5 profit, $6 profit on this one, where it'd be at maybe a $6 or $7 profit here. But here we're talking about almost 100% gain. Here would be close to a fair gain, right? It would have been up to $7 or $8. So it depends on what you expect to move. If you're expecting a 15 to 20% move, a low-cost strangle can be really effective. But with most of the time with earnings, when you're expecting 4, 5, 6% movement in the security, maybe even up as high as 7 or 8%, I feel the straddle is going to outperform the strangle because you have to move further to start seeing reasonable profits on the strangle because they're farther apart. And that's, in that structure. So depends on what you're looking at. If you just told me, Terry, that you picked 10 stocks to play around earnings this year and all of them moved 12 or 15% up or down, 50% moved 12% up, 50% moved 12% down, I could probably show you that the strangles would outperform the straddles. But over time, trying to use this as a strategy in your portfolio, you're probably going to see more along lines of an average of a 7 to 8% movement on the stock. Some are going to hit 12 or 15. Some are only going to move 2 or 3. And in that case, I feel the straddle is going to be more profitable long term. Okay? But hey, what about the shorts? Well, the prices I showed you for entering the long straddle and the long strangle were at midpoint. So if I took the same options and instead of buying to open those as the V straddle or selling to open them as the U-shaped strangle, if I sold to open both, we'd get the reverse. We'd get the tent profit and loss chart for the 125 straddle. And again, instead of paying 680, we'd collect 680 at midpoint. The strangle, that would give us this structure here. And at midpoint, we'd still have the cost of 295. January 15th, target drops down to 117, that minus 6.6% move. I'd still have to buy to close my 125 put for 825. This would now be a loss of 145 because it moved too far down. 6.6% was too far. You say, okay, well, if I'm doing an earnings play, I'm not going to do a straddle because I expect the stock to move. I don't want to do a short straddle even though it gives me a better premium because I want to have room for the stock to go so it doesn't hit either strike. Well, if we chose those same ranges, 5 points out of the money, you'd have collected 295, would have cost you 305 to buy to close the put. You're at a loss of 10 cents on the short. And that's with a 6.6% move. Okay, so you say, well, wait a minute. We're cherry picking. We're looking at a particular one we know the answer to. So let's go further. We know it dropped to 117, so what if I went further out of the money? Okay, let's drop 10% down. Target was only down 6.6%, and our comparison short straddle and strangle would have been a loss, where both the long straddle and the long strangle would have been a win if we saw the long straddle perform better. But what if you planned for no more than a 10% move? You thought the target could swing up 8 or 9% or might swing down 8 or 9%, but not hit that 10% mark when we were trading at 125. Okay, so let's go 12 points out of the money. Sell to open the January 17, 137 for 16 cents. Going further out of the money, even though earnings are coming up, we're not getting a lot of premium. Sell to open the January 17, 113 put at 45. All right, so we would have gotten 61 cents in, and we're further out of the money. Same upside down plateau, upside down U, profit and loss chart, but at 113 and at 137 with the stock trading at 125. We know it ended at 117, so what would have happened? 137 call expires worthless, 113 put expires worthless. We've taken a profit of 61 cents. Now, that's a profit less than half of what we took in with the long straddle with a 6.6% movement. Remember, we were a profit of 145 on the long straddle. What is your margin requirement for a short strangle? Remember, you're selling a 137 call, which is a naked call. You're selling a 113 put, which is a naked put. Now, brokers give some allowance for this type of structure. They don't charge you usually the full margin for the naked call and the naked put, but it might be the full premium of the put plus premium received for the call, or it's reverse. It's the full premium for the naked call. I'm sorry, full margin you'd have for a naked call, plus the premium you receive for the naked put position. So if that's the case, you're up to $13,745 to make $61. Not $610, $61. So what's the return? You got premium, but at a high cost. And if this was a surprise, you had one of those surprises where it dropped 20, 25, or 30%, okay, what would 25 be? Well, it would have been twice, right? So 10% move was 12 points, 20% would be 24, plus another 6 would be at 30 points down from 125, it'd be at 95. That'd be a 30% drop if there was a tragic miss on target for their earnings. So we're at 95. What does that cost me to buy back the now in the money short put at 113? Well, that's $18. So you'd have a loss of $17.39 per contract. Is it worth the risk with a short straddle or short strangle, no matter how far out of the money you go? I don't feel it is. That's why we stick with the longs, personally. Buying the straddle, buying the strangle, which one depends on what your expectations are for the position and what your risk tolerance is. But again, I just mentioned that we prefer the straddles. So the other questions to follow up, well, how far in advance of earnings should you place the trade? Again, we try to focus on a certain range. I don't have the specifics yet. That's still Ernie's wheelhouse, what he's developing for us. But usually I think it's no more than 10 days before the earnings. How far at an expiration? How far out in expiration? So earnings are coming out on the 15th. Do we do it the same week with that Friday or the following week? And the answer is usually the same week, I think, or the following week might be good too. But it depends on what's available. Now, what do I mean by that? Let's say I have a stock. I do have a stock that just offers monthly expirations, no weeklies. And let's say the earnings are coming out next week on the 23rd. Normally, I'd want to buy on the 24th. I'd want to set my expiration to the 24th, closest to the earnings date, but I can't. There's no weeklies. So I have to go out to February 20th if I want to play that particular stock at that point. Or on that stock, I might wait till later. Wait till we get in within 10 days to that earnings event coming up. But I'm sorry, I said that wrong, but you see what I mean. It depends what's available. If you just have monthly expirations, no weeklies, then you're not going to be able to set it as close in as you want. You're going to have to go to the following expiration. And a question may come in is, why don't you just go further out to begin with to give yourself more time after the earnings? Well, see, here's what Ernie's trying to develop in this case. Ernie's trying to develop, and he's pretty close. He's got it developed. He's just doing the write-ups on it, the videos on it, and so forth. But here's the rub on that. The idea is to create a potential strategy to use in earnings in your portfolio, which, by the way, when we're talking about this and you're seeing the potential that if the stock doesn't move more than 1 or 2% on that straddle, I could have lost near that full 680. I could have seen a 70, 80% loss if it only moved 2 or 3%. Okay? That's a possibility and a potential outcome. So what does this reflect a little bit underlying that? This should only be a small portion of your portfolio. You should not do this with the major portion of your portfolio. It should only be maybe 10% of your total portfolio funds, maybe even less, because you're trying to play a lottery ticket. You're trying to play an unknown where you could have a significant loss on your investment, especially if you're selling, but you could have a significant loss just on the buying side with a potential for high return. So why am I not buying a straddle or strangle 2, 3, 4 months out around earnings? Because we're not looking to manage it. It's sort of what I just said. It's like a lottery ticket. It's a fire and forget position. I want to put it on, knowing I'm going to see an IV crush, get the movement, close the position to get the profit that I want. I don't want to spend 3 to 4 weeks saying, oh, target fell 6.6%, so let me sell my call for nothing. Let me sell my put that's in the money. Now let me buy another put in case it keeps falling at a different strike price, and then let me buy a call down here at the new price in case it rebounds up. That's not what you're looking to do. You're just playing that one event. So get it, set it, shorter term. The event happens 1 or 2 days after the event happens, or even after the moment the event happens, you may just look to close both legs. All right, how do we trade straddles and strangles? Well, what we're going to do is buy to open both legs, as we talked about, for a straddle or strangle position. Buy to open the call, buy to open the put. We like the straddle that's at the money. If you wanted to do the short strangle, I will never recommend it, short straddle or short strangle, especially around earnings. Too much risk inherent. But you'd sell to open both legs. And what do you do to close it? Well, when you've hit your targets, you just do the opposite. So now I'm going to sell to close that bought call and that bought put. That's it. Don't leave them open. Okay, don't leave them open through expiration. I made that mistake with Texas Instruments. We talked about that a few weeks ago, but Texas Instruments years ago, I had it as a married put, and I decided to play earnings a little bit extra. So with a smaller portion of my portfolio, I also added a strangle. No big deal. Texas Instruments went off. It only had a 4% movement. The straddle and the strangle, or the strangle I did, I'm sorry, I think it moved up. Did it move up? Give me a second here. No, it moved down. It was a 4% down. and it went below the strike price of my put, but not quite to break even. 2 days to expiration, so I held it open. Actually, I thought I had 7 days to expiration. I made a mistake. In my power options portfolio, I entered it as a Friday the 13th. The earnings came out on the 4th. In my actual portfolio, I took Friday the 6th. So Friday came down. I still thought I had 5 more days for the stock to continue to drop to try to get it to profit. It didn't. What happened? Puts in the money. Call expired worthless. In my power options portfolio, I had the wrong expiration date. So I did have a married put already. But what they did with this position is essentially shorted stock for me, right? Because my obligation here by buying a put is that I can force someone to buy shares of stock for me. They didn't use my stock. I woke up Monday morning and was short shares of Texas Instrument in that case. Okay, so you don't want to leave it through expiration if one of those legs is in the money. You want to close it out as well. Okay, all right. Yeah, Jerry, I'm going to get to all you guys in just a moment. I see a lot of questions coming in, and comments are coming in on questions that were asked. Okay. Okay, Sam says my options trades is 25% of my portfolio, 20% of speculation trades. Right, so he's using 20%. But Sam, to my point, I know that you're doing other positions with options in that portion of your portfolio. I appreciate your comment. Don't get me wrong. But what I want to ask in that case is, how much do you think your portfolio, Sam, is allocated to earnings straddles or earnings strangles, or the straddles or strangles that you use? You said 20% of your total portfolio is to speculation on options, which is multiple strategies. Some bull puts you use, some other positions as well. But just for earnings straddles, what is an estimate of what you think your percentage is? Mine's about 5. The 5% of the portfolio I use with this kind of structure and this strategy. It's a little bit different from Ernie because I haven't seen Ernie's full report on what he's doing yet. So that's kind of what it is there. All right, so Terry, I hope that answers your questions about the straddles and the strangles. You'll be able to see more of that coming up soon. Okay, but you can always go to the powerop.com/longstraddlevideo.asp. Part 1, the introduction to straddles, is available there. You can also access it under the Long Straddle tab. Just go to Long Straddle and you'll see the introduction to straddles video. Parts 2 and 3 are part of the full product, which includes the concepts more in depth that Terry's asking about. Full disclosure on testing and actual trading that Ernie did with different styles. Had a question last week. Oh, I'm sorry, it was a YouTube comment from this conversation we had 2 weeks ago on a little bit on straddles and strangles, and the comment was, why don't you buy a month away and close beforehand when volatility increases? The answer is because that was part of what Ernie tested. And that strategy of buying a straddle or strangle a month before earnings, and as you get closer to the earnings, the implied volatility creeps up and you sell to close both legs before the earnings event happens, was not as profitable as doing the straddle shorter term, going through it, and taking the profits or moving the position one way or the other. But all that's going to be more available, parts 2 and 3 of the full product, when Ernie gets that all done. And Terry did ask 2 other brief questions for us. How to place a collar. Should we sell calls when our goal is to hold the stock for appreciation? The answer to that second part of your question is no. Collar is a different strategy. Okay, we're going to review collars on power options. Maybe not now. We're going to take these other questions, Terry, and then I'll come back to the collar discussion. But in general, the collar structure is standard collars, just like a covered call, but you're adding that extra out-of-the-money put. So again, we can take target as an example at 125. We'd never use this as an earning strategy. But with target at 125, I might sell a 127 call for an expiration 3-4 weeks out in time. So be selling the 127 call and maybe buying a 120 put. All right, so it's like a covered call. I'll still get a positive premium to reduce the cost basis. But if something drastic happens and the stock does fall, I'm protected better than a stop order. And I can still make 1, 2, 3% yield if I get assigned, which is what I'd want. If I have a 125 stock, Terry, and over the next 30 to 60 days, I expect the stock to be trading at 129, 130, or 140, I'm not doing a standard collar. All right, that's more of an income play to do on a position you're not planning on holding long term. You can maybe sell a call from time to time if you think you've peaked out at a top, but remember what happens whenever you have a stock and you sell a call. You cap the upside. The best time to do that is when you think you're at a high and the stock has lost steam and it's going to be pulling down. That's where I want to sell the call, not when I think it's a good stock and going up, unless my goal is to be assigned get out of the position, and just move on. All right, so we probably don't even have to review that. That's pretty much the answer. The answer is no. If you expect appreciation to continue, especially if you expect strong appreciation, you don't want to be necessarily in a covered call or a collar position if you're looking to hold the position long-term and for more appreciation. Wait till you think the stock has peaked, and then protect that perhaps with a put, the gains that you have, and then sell a call, because if the stock falls after that, you want the call to expire worthless or buy it back. You don't want to risk assignment or paying more to have to roll it. Second follow-up question from Terry. Moving protective puts when the stock goes up. This is related to the radioactive trading techniques. Income method number 4, when as the stock moves up, we can reposition the second asset, the put option, to lower the risk by maybe 50% or potentially even bulletproof the trade. I could do that pretty close right now with one of my positions that I'm in that we opened in December. But the question is, how often? Well, we're going to address that in a Blueprint Owners Only webinar. It's also discussed in the Fusion lessons there for Fusion subscribers at radioactivetrading.com. But the answer, of course, also comes down to your expected profit targets, your expectations for the stock. And we'll address more of that for Blueprint owners, Fusion subscribers in a short while, in probably less than a week or two.